Anant Shirgaonkar to talk about markets and where he's identifying spots of opportunity in this market. So, Anant, good morning. Thank you for joining us. What has been the tone of your activity in the market? Are you maintaining a balance of long and short both, or are you out of your long positions by now?
No. So, good morning. The way I look at the markets is stock specific and sector specific rather than trying to judge whether the Nifty would go up or down. And the way I buy my long positions is also for the longer term, which could be like 3 to 5 year kind of a view. And therefore, I wouldn't want to trade in and out of my long positions. So I maintain my longs. And of course, from time to time, I would try to find stocks or sectors which I find are overvalued or have gone beyond the valuations which can be justified, and I'm happy to sort of hedge my long portfolio with that. That's how I'm trying to negotiate this volatility in the markets.
What a tone of what your long positions are. I mean, we know that you've been bullish on logistics and liquor and some of the brewery stocks. So are you still maintaining your longs there?
Yeah. So I mean, I'm very positive on alcohol, on QSR space, on logistics. So none of those positions have changed. And I think individually, stock by stock or sector by sector, I think in the next 2 to 3 years, we would see improving prospects for each of these. So I'm happy to hold on to those longs.
Anant, why logistics? Because this is a story which did not really take off even when there was this barrage of e-commerce websites which came knocking on India's doors. Why now?
So I think what happened was you need to understand how the stocks were bid up. One on the back of e-commerce and second on the back of hopes that GST would actually trigger huge earnings upside for these logistics names. What the market sort of did not anticipate was the distortion or slowdown that would be caused by the time GST actually stabilizes. That is what gives us an opportunity to accumulate these logistics companies after the GST disruption. So I think now is a great time to look at logistics names. Even now, I guess in the next few quarters, we would see disruption from the e-way bill launch, which would come in April. That would take a couple of months or quarters to stabilize. But I think this could be a great buying opportunity, and we should look at the next 3 to 5 years, wherein if the economy were to recover after that, then the real benefits of GST would come into play. And all these logistics players are very high operating leverage plays. So the earnings swing could be really big in these logistics names. That's what I'm really betting on.
Okay, fair point. Anant, I know we've had this discussion over the last year and a half as to why you believe that Kaya is a great story, and as to how, just about everyone is now going for these wellness packages. It's the beauty business and cosmetology, which is really a fad, which is, becoming part of our daily lives. But you still continue to believe that Kaya is the go-to company because it's a very limited listed space as well.
Yeah, exactly. So the point is one of the very few plays on high affluence which might come through, and again here the stock and company got adversely affected by demonetization last year, which basically just got down the footfalls of consumers because the sentiment was really damaged. What I think is that we should look at it in the next 3 to 5 years, wherein the operating leverage would start kicking in as the businesses flow through. Now this company has got two businesses. One is in India and the other one is a similar business in the Middle East. 50% contribution from each of those areas. What is happening on the India front is that the consumer footfalls are increasing. They've already launched a few new therapies like hair transplant and hair growth, which has got a huge market. So if you see what played out in the last quarter was that the India business ticked up a bit. As we see consumer footfalls flow through in the India business, the operating leverage would flow through. The Middle East business gets affected surprisingly by the crude movement, because that changes the disposable income. in that region. And my sense is, again, the market over there is huge. So once we see that stabilize, I guess we could see both the India and Middle East business kick in for Kaya. And over the next 3 to 5 years, I think this could be a huge money spinner. That's at least my expectations.
Oh yeah, definitely. I guess the market for cosmetology in the Middle East is far deeper than India, and deeper pockets as well, if I can say that. But why Jubilant FoodWorks? I mean, what is the kind of return that, Anant, you're expecting? The stock is still pretty much close to its 52-week highs, 2,000 plus on a per share value. And you know, those bad days, negative same-store sales growth numbers clearly are behind us. We've seen that recovery. That recovery seems to be well in the price. How much more returns are you expecting on the stock from here?
So I think very bullish on Jubilant FoodWorks even from here with the next 2 to 3 year time frame. So I guess we were lucky to get into the stock when there was negative news flow, and the turnaround so far has played out well. If you notice, what the management has been doing is that they actually took on consumer feedback very seriously. One, on the pricing front, they corrected the pricing, got the everyday value offer in play, which has been lapped up by the consumers. They took the product feedback very seriously. They've upgraded the products. That's been lapped up by the consumers very well. And the management focus has changed now only from SSSG to profitable SSSG, and we've seen that play out in the last 2 quarters. I think what is happening in the consumer space is that not all consumer sector spaces will grow at a very high rate, and we've already seen that play out in certain spaces. So money would actually flow towards those sectors or spaces wherein consumer growth continues to be very strong, and I think therefore I would see more and more funds continue to increase their weightage in Jubilant FoodWorks. So I guess, not being blinded by the returns that we've got so far, I think it's in a sweet spot, and we could see very strong returns even from here.
Anant, the go-to short space for everyone has been go and sell PSU banks, and for those who were able to just look beyond that recapitalization excitement, I guess this has turned out to be the best short trade. I mean, if you went short on the stocks when they saw a pop immediately after the balance sheet was recapitalized, they are in the money by 25, 30, even 50%. Is that short trade now getting very crowded, or you think one should structurally remain short on PSU banks?
See, I was never short on PSU banks, and to that extent you can say I missed out on the trade, but I don't intend to make money on every trade that plays through. On the contrary, I think I would like to hedge my portfolio with private banks and certain consumer NBFCs. I think there the valuations are very high. It seems like a consensus buy, and everybody is hiding into these private banks and consumer NBFCs and other NBFCs just because the PSU bank space has sort of bombed out. I think there's over ownership over there. The index weightage for this financial space is very high. At the margin, there could be both growth issues and asset quality issues which can crop up selectively for some of these banks and consumer NBFCs, and therefore the valuations could take a knock. That is the space that I'm pretty worried about.
Okay, Anant, let's also talk about the IT space. It was not a short trade, but the IT stocks have made a comeback largely because the markets are worried about cost of capital going higher. You don't want to buy companies which are in financial space or which have a debt on their balance sheet. What is your sense now? I mean, are IT stocks priced to perfection, or they can be the outlier stocks on the upside in this for 2018?
So I don't know about whether they can be an outlier for 2018, but I'm not so positive on the IT space simply because I guess if you look at the IT cycles which have played out from 2000 onwards, every 5 to 6 years, we've seen that the growth rates every 5 to 6 years have been lower than the previous cycle growth rate. And I wouldn't be surprised to see that the next cycle's growth rate would be even lower than the previous one. So in the India context, wherein we expect significant 15+% to 25% kind of growth from companies when they are in a sweet spot, I think IT companies may struggle to qualify on that ground even in good times. So you could see a one-off IT company do well for a year or so, but over a 3 to 5 year period, and I think there could be better opportunities in the market than the IT sector.
The one space in the market which has clear visibility, both in terms of a growth trajectory as well as steady order flow, good news flow, and I guess this is one of the only sectors wherein you are seeing some positive news flow almost on a daily basis, and that's the road EPC companies, with the NHAI now allocating a fair amount of highway orders. Most companies like Dilip as well as Ashoka bagging some hefty orders as well. The only concern here is that valuations of these stocks as well are looking extremely rich. Do you sense that there could still be scope that these stocks could be sort of bereft and isolated in that sense of any negative market volatility, and one could still buy into these names?
No, so I've never participated in this road companies and the road infrastructure plays. One, because I'm not well versed with these companies, and I'm not sure about the management quality, because when you're investing for 3 to 5 years, you should be very clear that the management quality is top notch, and that the management interests and minority shareholders' interests are aligned. So that's point number one. Secondly, you've seen this in the previous cycle as well. There were order flows, but didn't really translate into sustainable profits for the minority shareholders. So unless I see evidence of that come through, I don't think I want to jump into these road construction companies just because there are order flows coming through. I think ultimately what would create shareholder value is sustainable profits and free cash flows. So I think we need to see more evidence of that play out from these companies before we jump into these road construction names.
A news event or something, there's a dividend of 21 rupees, which will have an impact of 6%, 6.5% on Vedanta stock price. 1 or 2% could be because of market, but there's a 21 rupee dividend, so you knock off 21 rupees out and then you have to look at it. Meanwhile, we've got flashes from agencies. This is about the Mehul Choksi to CBI. My passport remains suspended. We are quoting agencies here. I'll wait for more flashes to load up. Assure you that I'm not making any excuse. I'm ready to travel whenever required. Now that is just an excuse coming from Mehul Choksi that look, my passport is suspended and I cannot come. I'm sure if he wanted to come, there would have other ways in which he could have voiced the comment rather than really giving a comment to CBI. Vedanta, well, let me mention Vedanta once again. There is a dividend element which is at play here, and that explains why Vedanta today suddenly is trading 6.5% lower. Anant, the demand and the supply side for global metals is looking rather decent now. Supply has got curtailed because of discipline coming from China. Demand seems to be opening up because of better economic growth coming from US and from Europe. Is this a good time to buy into the current leg of weakness into Tata Steel or Vedanta?
So I think I'm a bit confused about metals, honestly, because last year I think I was much more certain that the valuations on our side and the demand supply is pretty robust, and we played onto the long side on metals. Now I think there could be, it still qualifies on valuations. However, what I'm not sure about is whether this correction that is playing out globally is sort of indicating that there could be some global troubles either in Europe or the US, which might then flow into other countries. Secondly, we've seen tariffs come in from the US, which is definitely not good for now, although the news flow that came in was much more tempered as compared to what the market was expecting. Even after that, there has been news flow about the trade wars with China and how there could be more measures coming in on specific countries. So I think that is the reason why the metal names have been derated, and unless we see that kind of rhetoric subside, we don't really know what turn this could take, because we already had Europe talking about how they would retaliate in case there are measures, tariff measures from the US. So I think we need to see some more sanity and stability in the news flow on that front. I think China news flow in terms of demand supply and curbing of supply is well flagged off since last year, and it has been baked into the price. The new news flow that we need to take care of is the US and what actions may come out of US and what, if any, retaliatory actions may come out from Europe/China. So I think we should hold back a while and see that things stabilize on that front. That's very critical, and it could actually derail the entire global growth story.
All right, Anant, always a pleasure to talk to you. Thank you for joining us.